Welcome to another video about investing/trading. So, watch this video very carefully and feel free to share it with your friends and family. I do understand that there are lots of misconceptions about leveraged ETFs. So, in this video, I'll talk about how you can make money on leveraged ETFs. So, all right, so let's get started. So this is for educational purposes only. Use this information at your own risk. So basics. So what is a leverage ETF? Leverage ETF is X times the underlying. So we'll mostly talk about NASDAQ and QQQ. That's the regular ETF for NASDAQ. That's just one time. And TQQQ is long NASDAQ 3 times. And SQQQ is short. So in other words, if QQQ goes up 1%, TQQ will go up 3%, theoretically, not always. And SQQ will go down 3%. Again, not always, but theoretically, that's what it's supposed to happen. And the way the fund managers do it is an intricate process. There are lots of things involved, futures and options and swaps and all of that. So that's a topic for another video. Here, you just need to focus on how you can make money using the leveraged ETFs. Okay. So some of the misconceptions are, they're not good for long term. Okay. You'll find tons of videos on YouTube and other places and tons of information as to why they're not good for long term. Not only there are videos, actually, if you look at their prospects, they also tell you that they're not good for long run. But I'll show you, there are times when they are good for the long runs. And the second one is they're always X times the underlying. Well, they are not, sometimes they could be less, sometimes they could be more. Okay, we'll look at that as well. And all leverage ETFs are, people lump them into either they're good or bad, but I'll show you which ones are good and which ones you need to stay away from. Okay. I mean, there are lots of other misconceptions, but today we'll just focus on these 3. And these are frankly the most important ones anyway. So let's take on the first one, which is they're not good for the long run. And I'm going to move myself out of the way here in this corner. Okay. So this is actually long-term chart starting from 2010. And actually, this is a chart that I had made some time back. So sorry, it's not the most updated one, but so it's starting right here from 2010, because that's when the TQQ came into existence, okay? And it's over here, 2020, beginning sort of. And again, I apologize, this is not the latest one, but for the sake of this discussion, it's perfectly fine. So as you can see, this one is actually TQQ. It's doing way, 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 way better than, guess what? The darlings of the Wall Street, which is Facebook, Apple, Amazon, Google, Tesla, all right? So if you see this, it's doing better than all of these, all right? So sorry about that, something in my eye. Even if you had gone with, so TQQ is 3 times NASDAQ, and then URTY is 3 times Russell. This is 3 times, SPXL is 3 times S&P 500, and UDOW is 3 times Dow. By the way, there are more than one ETF. So it's not just SPXL. There are other ones that are 3 times S&P 500. I'm just using these. You could use whichever leverage ETFs you want to use. Okay. So even if so the ones that are circled are the leverage ETFs. So the leverage ETFs based on indices. Okay. So you didn't have to pick any stocks or anything like that. You could just have picked the leverage ETFs and you could have still made money. This chart, actually, I'll talk about this in the next chart, but as you can see, you are making a lot more than any of them, okay? Let's move on to the next one. And so the next misconception was they're always X times the underlying, so I'm saying they are not. So the misconception was they are, so I'm saying they are not, okay? And I'll give you a good example. See, over from 2010 through 2020, like almost 10 years, NASDAQ went up 300%, close to 300%. And you see TQQ went up, went down, still it went up 4,220%, more than that. So 3 times 300%, if 3 times of this would have been 900%. But guess what? It actually, sorry, let's go back. It actually went more than that, lot more than that. Actually, more than 10 times, almost like 15 times, okay? So 13, 14 times. I'm doing the math in my head. So close to 14 times, okay? So instead of 3 times, why did it go 14 times? So this is actually 14x. And if you actually see this is actually 6,700 times. It's way more than that. The reason for that is because when there are more up days, it's rebalancing. The leverage ETF is rebalancing every day. When there are more up days, the rebalancing actually works in your favor. And I'm actually going to show you that when there are down days, the rebalancing actually works against you. So let me show you over here. So this is TQQ, and just moving myself away a little bit. So this is TQQ, QQQ, and SQQ. This is actually the day when TQQ, as well as NASDAQ, was at all-time high, which was February 19th. So this is the day, let's say, if you would have taken a position in TQQ, which is the long ETF, okay? And SQQ is the short one. So this is the long, and SQQ is the short one, okay? So long, I'm saying that long ETFs you should invest or hold them for a long period, versus the short ETFs you could actually hold them for a short period and make money. So let's say on this day, if you would have shorted the TQQ, shorted the NASDAQ by buying SQQ, okay? So you're going long SQQ, you would have made good money over here. You would have actually doubled your money right over here by March 14th, okay? So you would have doubled your money. But if you would not have cashed out, guess what? Even though the NASDAQ as of today is down 3%, you would have been down, so pink line is SQQ, you would have been down 37, 38%. Guess what? You're expecting that, oh, NASDAQ is down 3%, so SQQ should be up 12%. No, it's actually down 40%. So when people talk about leverage ETFs are bad, actually this is what the situation is, okay? And even if you look at the long one, look, even though QQQ is down 3%, TQQ is actually down 33%. So it should technically be down 9%, but it's down 33%, okay? Why? Because you're looking at a shorter period. As I showed you in the previous example, over a longer period, you actually get a lot more than 3 times. Why? Because there were a lot more up days, when it was going up. That worked in your favor, versus even though there were actually more up days, if you look at the time period between February 19th through today, actually 2 months almost, May 18th, it is, there were more up days than down days, but the down days actually were more brutal. We had sell-offs like 5%, 10% down, okay? So that's what hurt the market. So long leverage ETFs, you should hold them for a long term. Short ETFs, you should hold them for a short term, for trade, get in, get out, okay? And then, there are the third misconception was all ETFs are good or bad. So let's look at the bad ones, right? The oil and the natural gas are terrible. Many of them actually have been liquidated, discontinued, whatever. They've lost like more than 99.9999% of their assets. So they've been shut down. So the oil ETFs are terrible, but actually they were terrible. They are good now because they are down so much. And the ones that have survived now, you could actually, there is NRGU, I doubled my money on that. So there are some that you could make money. And let me show you the good one. The good one is TQQ, which is, why am I so bullish on TQQ? Because technology is the future. Artificial intelligence, drones, blockchain, you name it, technology is almost 50% of NASDAQ. And TQQ is 3 times NASDAQ. And I showed you in the previous chart, you can actually make a lot more than 3 times. In TQQ, as I showed you, between 2010, actually it's like 6,700%, which is $100,000 investment would have become $6 million. All right, so that's the fun part. So how do you, like, I'll talk about the invest and the trading part. How do you invest? So the long leverage ETFs are better than the short leverage ETFs, as the market has a long-term bias. So invest in the long ones, okay? And don't invest in lump sum, use dollar cost averaging. Actually, NASDAQ has come up a little too much now. So you may not want to put all your money in it. You may want to start dollar cost averaging into that, okay? And plus, some of you may be skeptical because we're not out of the woods yet as far as COVID-19 is concerned, or coronavirus. But hey, you know, it's if you are thinking of investing, forget about the timing, the market. Okay, if your plan is to invest $1,000 a month every month, so put that in place. Don't invest in lump sum because you never know where the market is going to go. Okay. How about the trading? The trade one is go long on like oil ETFs, which are down more than 95%, and also look at the prospectus. Some of them look at the net assets. Some of them are really low assets, like $2-3 million. Actually, NRGU was like that, and I took a chance and I made money on that. But there are others, UCO, Gush, ERX, and there is okay, Gush, UCO, ERX. These are energy ones. I don't know about ERX, but let me quickly look at something over here. I actually remembered that, but for some reason, anyway, so I'm gonna find that in a second. My phone is coming up. But anything that has lost more than 95%, like 99%, yeah, invest in those. So UCO, Gush, ERX, and NRGU, okay? So NRGU is still, I think, 3 times. The other ones have gone down, but now would be a time. But again, you know, I'll tell you how to exit, but be cautious, okay? Use only the money that you can afford to lose. And if you want to short something, you know, the leverage ETFs, which are inverse, which are bear leverage ETFs, inverse ETFs, those you don't even have to time the market, as I showed you. I mean, go back over here. So even if you would have shorted it right here, I mean, there would be a pain in the short run. Look at this. This is the pain point. But guess what? You would still have made 40% because you are short SQQ. Okay. So this is the pink one, is the short SQQ. So if you're willing to take some, you know, short-term pain, there could be short-term pain. Okay. Then that might turn out to be safer. So long ETFs such as TQQ, which is based on an index, those are the ones you need to be long for the long term. So that is for investing. And the ones that are based on oil or something, or just one trick ponies, you buy them in, you know, like when they're down quite a bit, but make sure be cautious. And I'll tell you in the next one how to exit out of that. And if you think something has gone up too much, look for a bear leverage ETF and short that. And as I showed you before, you can still make money on that. So exit for the trades. This is not for investing, okay? Investing, you're holding it for the long run. Exit for the trades this is for leverage commodity ETFs and anything that you're trading for the short term. Take half off after your initial investment doubles, because you don't know, like ERGU, UCO, ERX, gosh, you don't know what's going to happen to that. Okay, if you double your money, take that half, sell half. What that means is, let's say if you had invested $100 and it became 200, okay, and you take 100 out of that, guess what? You are riding with the house money. There's no risk, so let it ride, let it go, as high as it can go. Okay, and finally, stay healthy and safe and make tons of money. All right, thank you for watching this, and feel free to share this with your friends and family, and I'll see you in future videos. All right, good luck with your trading and investing as well.